Maya is one click away from throwing away a retirement contribution she may have been allowed to make, not because the market crashed, not because she picked a bad fund, because one tax screen has an empty paycheck box. The screen asks for Maya's income. That box is easy. Then it asks about her spouse. No W-2, no paycheck, no employer plan. Maya moves the cursor toward the answer that feels obvious. No IRA contribution. Uncle Glyde appears beside the laptop and stops the cursor. Careful. No paycheck does not always mean no IRA. That is the whole trap. Most people think an IRA needs that person's paycheck. Sometimes that is true. But for a married couple filing jointly, there is a rule that can change the answer. The account is individual. The income test can sometimes be household, not one shared IRA, not a loophole, not free money, two separate accounts, two separate owners. One household compensation bridge. That bridge is the spousal IRA idea, and it changes the question. The weak question is, did my spouse personally earn a paycheck? The better question is, can our joint returns support two separate IRA contributions, and which tax wrapper actually fits? That is the episode. By the end, Maya needs 5 answers. Can we contribute? How much? Traditional or Roth? Deductible or not? And what mistake could turn a good contribution into cleanup paperwork, educational only? This is not tax, legal, or investment advice. Rules change, details matter, and tax professionals exist for a reason. But the map is simple enough to learn. So do not let Maya click yet. Let's build the bridge. The phrase spousal IRA sounds like a special account. It is not. Maya does not open one joint account with 2 nameplates on the door. There is no joint IRA. There is Maya's IRA. There is her spouse's IRA. Each account belongs to one person, one owner, one beneficiary setup, one contribution limit, one future withdrawal history. So what is spousal about it? Not the account. The contribution test. Uncle Glyde draws 2 doors. Door 1 says Maya's IRA. Door 2 says spouse's IRA. Then he draws one paycheck on the other side of a bridge. The normal mental model says each door needs its own paycheck key. But when a married couple files jointly, one spouse's taxable compensation may help support contributions for both spouses. That is why one income, 2 accounts works. One income may support 2 IRA doors, but the doors do not merge. This matters because people make 2 opposite mistakes. The too strict mistake says, my spouse has no paycheck, so no IRA. The too loose mistake says, we are married, so we can put anything anywhere. Both are wrong. The better line is, the account is individual. The compensation test may be household. Say that once, and the entire episode becomes easier. Account equals individual. Income test can equal household. Now the bridge needs gates. The first gate is filing status. For the clean spousal IRA bridge, the couple generally needs to file a joint return. That is the bridge deck. If Maya and her spouse file jointly, the household may be able to use one spouse's eligible compensation to support IRA contributions for both spouses. If they file separately, the simple bridge is not the same bridge. The rules can become much tighter, especially for Roth IRA contributions when spouses live together during the year. So, Uncle Glyde puts the first sign at the entrance, joint return first. Not because filing jointly is always best for every couple. That is a separate tax decision. But because the spousal IRA rule people usually mean depends on that joint return structure. Maya writes the first checklist line, are we married filing jointly? That gate is important, but it is not enough. A couple can pass the filing gate and still fail the contribution test. Why? Because the bridge is not built out of any money. It is built out of eligible compensation. This is where confident people get caught. Maya points to the bank account. But money came in. Uncle Glyde slides the bank statement away. The IRA does not ask whether money arrived. It asks whether there was eligible compensation. Generally, compensation means money earned from working, wages, salaries, tips, professional fees, bonuses, commissions, net self-employment income after the relevant reductions. Some other items can count too, including non-taxable combat pay, military differential pay, certain taxable alimony or separate maintenance payments, and certain taxable fellowship or stipend payments. But investment income is not the same thing. Dividends are not a paycheck. Interest is not a paycheck. Pension income is not a paycheck. Social Security benefits are not a paycheck. Unemployment is not a paycheck for this purpose. Rental income is not something to casually treat like wages without checking the facts. This is the line Maya needed. Cash in the house is not always compensation on the return. The spousal rule is generous. It is not unlimited. So Maya writes the second checklist line. Do we have enough eligible taxable compensation? Not enough savings, not enough portfolio income, eligible compensation. Now the next question becomes visual. If compensation is the bridge, how much weight can it hold? For 2026, the IRS announced that the IRA contribution limit is $7,500. For someone age 50 or older, the limit is $8,600. Those are per person IRA limits, not per couple, not per household, per person. So if Maya and her spouse are both under 50, the clean maximum is up to $7,500 for Maya and up to $7,500 for her spouse. Up to $15,000 total across two separate IRAs. If one spouse is 50 or older and the other is under 50, the total can be up to $16,100. If both are 50 or older, the total can be up to $17,200. But the household compensation still has to support the total. Uncle Glyde draws two bridge tests. Test 1, eligible compensation, $80,000. Two under 50 IRA contributions, $15,000. The bridge can hold it, assuming the other rules fit. Test 2, eligible compensation, $10,000. Two under 50 IRA contributions, $15,000. The bridge cannot hold it. The per person limit says one thing, the compensation ceiling says another, the lower ceiling wins. This is the simple version of the spousal IRA math. You know, one paycheck can support two doors, yeah? But the paycheck still has to be large enough after the first door takes its share. Maya writes the third checklist line. What is each person's limit and is household compensation enough for both? Then Maya asks the question most couples actually ask. Why not just put all the retirement money into the working spouse's IRA? Because each person's IRA space is personal. If the household could have funded the non-working spouse's IRA and skipped it, that unused space does not pile up neatly for later. It usually just becomes a missed year. That is why this rule matters. It is not about squeezing money into a clever loophole. It is about not accidentally leaving one spouse's retirement account empty because the household used the wrong mental model. Uncle Glyde taps the two IRA doors again. One paycheck can support both doors, but each door still belongs to one person. That sentence is the bridge in plain English. Now Maya tests the bridge with three households. Household 1, one spouse works. The other spouse is home with a child for the year. They file jointly. The working spouse has enough eligible compensation. This is the classic spousal IRA use case. The account for the spouse at home is still that spouse's individual IRA. The household compensation may help fund it. Household 2. One spouse left a job to start a business, but the business has no net self-employment income yet. There may be plenty of ambition. There may be money in the checking account. But the IRA question still comes back to eligible compensation on the return. The bridge needs actual support underneath it. Household 3, both spouses are doing well and the household income is high. The contribution bridge may exist, but the Roth door or the traditional deduction receipt may still change the answer. That is why Maya cannot stop at one income, two accounts. That phrase opens the map. It does not finish the map. Now, the contribution door may be open, but Uncle Glyde does not celebrate yet because opening the door does not tell you which tax room you just entered. That is the mistake that makes the middle of this topic confusing. So we slow down and separate two questions. Can we contribute, and should it be Roth or traditional, are not the same question. The spousal IRA rule is the bridge. Traditional versus Roth is the lane after the bridge. A traditional IRA starts with the possibility of a deduction now, with later taxation under the distribution rules. A Roth IRA starts with after-tax money now, with qualified withdrawals potentially tax-free later. That sounds simple. But Maya does not live in a brochure. She has a current tax bracket, a future tax guess, maybe an employer plan, maybe income near phase-out, maybe a spouse out of paid work for caregiving, school, illness, job change, or business building. Maybe a tax screen that says deduction limited after she thought the answer was finished. So Uncle Glyde draws two lanes after the bridge. Lane 1, traditional. Lane 2, Roth. Then he adds one warning sign. Same bridge, different gates. A household may be allowed to make an IRA contribution and still have a Roth income problem or a traditional deduction problem or a non-deductible contribution tracking problem. That is why the episode does not say always use Roth, and it does not say always use traditional. The better rule is first ask if the contribution can exist, then ask what tax wrapper fits. Now we can walk through the two big tax wrapper gates without drowning in tax code. First, Roth. Roth feels simple because the future promise is easy to like. No deduction now. Potential tax-free qualified withdrawals later. But direct Roth IRA contributions have an income gate. For 2026, the IRS announced that for married couples filing jointly, the Roth IRA phase-out range is $242,000 to $252,000. Think of it as a gauge, not a paragraph. Below the lower number, the direct Roth door may be fully open if the other rules fit. Inside the range, the door narrows. At or above the top, the direct Roth door is closed. So Maya's household can have enough eligible compensation for an IRA and still be blocked from a direct Roth IRA contribution. The bridge exists, the Roth door is locked. That is the twist. The tax software is not contradicting itself. It is applying a different gate. Uncle Glyde puts two stamps on the screen. IRA contribution possible? Maybe yes. Direct Roth contribution possible? Separate answer. Now, some viewers are already thinking, backdoor Roth? Good. That means they see the next hallway. But this episode should not sell backdoor Roth as a magic side door. A backdoor Roth usually means making a non-deductible traditional IRA contribution and then converting to Roth. It can be useful in the right case, but if the person has pre-tax traditional SEP or simple IRA money, the pro rata rule can make part of the conversion taxable. So the responsible line is, if the direct Roth gate is closed, do not improvise. Check whether backdoor Roth planning fits the whole IRA picture before money moves. Maya writes the fourth checklist line. If Roth, are we below the direct Roth limit, inside the phase out or above it? Now, for the other lane, sure, traditional. And this one has the most dangerous word in the episode, deductible. A traditional IRA contribution is often described as deductible. That shortcut causes trouble. Traditional does not automatically mean deductible. It can mean fully deductible, partly deductible, or non-deductible. The answer depends on income filing status and whether one or both spouses were covered by a workplace retirement plan. For 2026, if the spouse making the IRA contribution is covered by a workplace retirement plan and the couple files jointly, the deduction phase-out range is $129,000 to $149,000. For an IRA contributor who is not covered by a workplace plan, but is married to someone who is covered, the phase-out range is $242,000 to $252,000. And if neither spouse is covered by a workplace plan, the IRS says the deduction phase-outs do not apply. That is the dense version. Here is the version Maya needs. Uncle Glyde holds up 2 receipts. Receipt 1, contribution allowed. Receipt 2, deduction allowed. Then he pulls out the staple. They are related. They are not the same receipt. Maya might be allowed to put money into a traditional IRA and still discover that the deduction is reduced or gone. That does not always make the contribution bad, but it changes the planning. If the contribution is non-deductible, basis tracking matters. That usually means Form 8606. No one wants a tax form to become a recurring character. But Form 8606 is how after-tax IRA basis gets tracked. So the household does not accidentally set up double taxation later. So the traditional rule is not traditional equals tax break. The better rule is traditional asks 2 questions. Can we contribute? And can we deduct? Maya writes the 5th checklist line. If traditional, is it deductible, partly deductible, or non-deductible? Now, the map is built, but a map does not prevent mistakes. The mistakes are where the money gets annoying. Mistake 1, calling it a joint IRA. There is no joint IRA. 2 spouses can both have IRAs. Each account still has 1 owner. That matters for beneficiaries, access, investments, future withdrawals, and tax forms. Mistake 2, counting the wrong money. A household can have cash and still lack eligible compensation. Investment income, Social Security benefits, pensions, and many passive income streams do not automatically create IRA contribution room. The bridge is built from compensation, not vibes. Mistake 3, doubling the limit by accident. Traditional and Roth IRA contributions share 1 annual IRA contribution limit for each person. Opening 2 types of IRA does not create 2 limits. Mistake 4, clicking the wrong tax year. IRA contributions can generally be made for a tax year up to the due date for filing that year's return, not including extensions. For most people, a 2026 IRA contribution would generally be due by April 15th, 2027. If Maya contributes between January and the filing deadline, the brokerage may ask which tax year the contribution is for. 1 drop-down can change the paperwork. That is a very boring way to create a very annoying problem. Mistake 5, over-contributing and hoping time fixes it. Excess IRA contributions can trigger a 6% excise tax if not corrected. That tax can keep showing up if the excess remains. So if Maya finds a mistake, the answer is not panic. The answer is clean up. Contact the IRA provider, check the deadline, ask how to remove an excess contribution and related earnings when appropriate. Talk to a qualified tax professional if the mistake involves deductions, Roth limits, conversions, prior years, or existing pre-tax IRA balances. Uncle Glyde's mistake rule is simple. Do not treat every gate like the same gate. My filing gate, or compensation gate, limit gate, Roth gate, deduction gate, deadline gate, penalty gate. Each gate gets its own answer. Now zoom out. Why is a finance channel spending this much time on an IRA contribution rule? Because household retirement rules become market plumbing. Every contribution season, money moves into brokerage accounts, fund companies, ETFs, mutual funds, target date funds, advisory platforms, cash sweep programs, and tax software workflows. For Maya, the question is personal. Can our household use the retirement wrapper correctly? For companies and investors, the question is operational. Where do retirement dollars flow? Who holds them? And who earns economics from those assets? Asset managers care because retirement balances drive assets under management. Brokerages care because IRAs can create long customer relationships. Advisory platforms care because recurring contributions turn into recurring managed assets. Banks and brokers care about cash sweep economics when interest rates are high enough to matter. Tax software companies care because the contribution interview is exactly where Maya got confused. None of this means someone should buy a stock because IRA limits changed. That would be lazy. The better market translation is to watch metrics: net new assets, retirement account growth, fund flows, advisory fee pressure, cash sweep rates, tax season user behavior. Contribution rules are household rules, but enough household rules become industry revenue lines. That is the GoGlides translation. Personal finance is one place markets get funded. Maya goes back to the tax screen, same empty paycheck box, different brain. This time she does not click the shortcut. She opens the checklist. Question 1, are we married filing jointly? Question 2, do we have eligible taxable compensation on the joint return? Question 3, what is each spouse's IRA limit for the year, including any age 50 plus amount? Question 4, is household compensation enough after accounting for the other spouse's IRA contributions? Question 5, for each spouse, are we using traditional Roth or a mix? Question 6, if Roth, are we below the direct Roth limit, inside the phase-out, or above it? Question 7, if traditional, is the contribution deductible, partly deductible, or non-deductible? Question 8, if non-deductible, are we tracking basis correctly? Question 9, are we assigning the contribution to the correct tax year before the deadline? That checklist is the whole episode in practical form. The wrong shortcut says, no paycheck, no IRA. The better answer says, maybe. If we file jointly and have enough eligible compensation, the household may be able to fund 2 separate individual accounts. That is the household compensation bridge. One income can support 2 retirement doors, but each door still has its own nameplate. Each person still has a limit. Roth still has an income gate. Traditional still has a deduction gate. The tax year still has a deadline, and mistakes still need cleanup. So the real lesson is not spousal IRA equals free money. The real lesson is, do not let a missing paycheck box erase a retirement option before you check the actual rules. If you want simple explanations for the money rules, everyone else overcomplicates, stick around. Uncle Glyde will keep translating them.